Guys, we should get started in 1 second. There we go. All right, here we go, Alex.
Hi, I'm Todd Gordon, and I can't believe it. It's been 8 years since I launched this business, and what a ride it's been. Welcome to TradingAnalysis.com. We're one of the leading education, analysis, and trading alert companies on the internet. We are a team of devoted professionals who trade our capital in a live, transparent manner to show you what the life of a trader is actually like. Keep in mind, this is an industry filled with smoke and mirrors, with cheap sales and marketing tricks, so it's been my mission to run an above-board, transparent, and brutally honest operation to serve our clients in the best way we know how to prepare them for life in the markets. Every single day we offer video and written analysis for the major trading markets, including stocks, stock options, cryptocurrencies, and Forex markets. We offer live and clear-cut and actionable trade alerts in these markets, and they're sent straight to your cell phone and posted in the members area on Trading Analysis. Once the trade is out, we certainly don't leave you hanging. We follow up on every trade, whether it's a winner or loser, and we'll conduct post-trade forensic to show you what went right, what went wrong, so you learn. And very soon, I'm going to be sharing my real-life seven-figure portfolio with our members who prefer the longer-term investment time frames with some medium-term trading and option strategies mixed in as well. So head on over to TradingAnalysis.com after this show is over. Take a trial today and join us in our community. Let's get back to the show.
Hey, Alex. How you doing, bro?
Hey, man. What's up?
What'd you think of that old commercial, huh?
Yeah, I'm just looking at it a couple of times until we started.
They don't know that. They don't know that the
Yeah.
first one was just a warm up. So, hey, how you doing? Welcome.
Yeah.
Happy New Year, man.
Hey, Happy New Year. Yeah.
It's not New Year in Serbia yet, though, is it?
No, it's on 13th of January, so we have 7 more days.
Right on. 7 more days to do everything you need to do before you start working out. No more vaping. You can't be doing that. Are you going to give that up for New Year?
Yeah. I'm not. That's a good one, man. I stopped giving that promises a long time ago. At the end of the year, you know. When I realized I'm not gonna fulfill any, you know. So
Exactly.
yeah, it's kind of a, you know, like blown out thing. It's gonna be a things I'm gonna change everything. So more I say that, nothing changes.
I hear you. So tell me,
I think these things,
go ahead, man. Go ahead, jump in.
These things are done in silence, I think.
What do you mean by that?
I mean, you don't speak, you do it, you know.
Oh, yeah, there you go. Yeah, I agree with that. Yeah.
Yeah.
All right. Talk to me what's going on here. Tell me what's up from your point of view in the market. I need 30 seconds. Fill the space. I got to adjust your shot. So this is in the TV world,
okay.
filling dead air. So tell me what's up with you.
Okay. So so I'm still observing the mentioned plateau on the Fed rates. I think they're going to plateau between 4.5 and 5%, which agrees with our overall outlook. So we're going to show S&P a couple of also sectors. I still stay overall bullish on the cycle degree. So I think either from here or a little bit lower down to March, we're going to continue higher in the next 2.5 years at least. Watching cryptos, interesting stuff there, yeah, looking forward to 2022. 23. Sorry, I think it's going to be a risk-on year. In my opinion.
Yeah, and we got some pricing data from the ISM this morning that came in a little weaker, along with Jolt's job data that was higher. I think like 500,000. I think that headline reading is supposed to be 10 million. It came out at 10.5 in terms of opening. So little indication of cooling in the labor market. Some pricing inputs came in a little bit lower. Of course, we have CPI next week, which is Thursday. And then we had Fed minutes that came out this afternoon, and surprise, surprise, like Powell was like bashing us over the head. Don't ever think you're getting away with less than 5.25 rates for more than a year. You know, bend over and you're going to like it. And say, thank you, sir. Can I have another? And, you know, the market sold off. We'll look at that. And then it kind of rallied back into the close. And in terms of expectations of where the Fed's going, it didn't go anywhere. You know, I thought...
Yeah, you know, I think this is still a thin market. You know, overall... Yeah. I mean, as you know, we have been so long on this market. I mean, where you're gonna see a real flows around 4th of January. I mean, it's still, yeah.
Yeah. People are still coming back in for sure. So just starting real simple here. This is the 1 minute S&P futures. So Fed minutes came out at 2 bells. Initial up, sold off hard as we read the rhetoric. You know, Powell, the minutes were saying don't take the lessening and the rate of change of Fed increases as a sign that the Fed is becoming complacent and expect longer for higher. And then the market sold off. And then I was like, well, wait a minute, that's something that we already know. And then, you know, you're very much in tune with where we are in terms of Fed. So we have a meeting in 2 weeks. Right now we're at a 70.2% chance of 25 basis points. Right now we're 4.25, 4.5. Since yesterday we went from a 67% chance of 25 to 70.2. So we went up 2.5%, like whatever. We're going 25 next time. And then into March, once we get to 4.5, 4.75, 13% chance that we go unched. 62.9 plus 13, right, is going to be called 63, 73, 76% chance that we only go 25 more, and only 23% chance that we see a 5 handle in March. And these didn't move very much, maybe 2-3% again from this morning's data, JOLTS, ISM, and then Fed minutes. So there really wasn't a big move. And then I think March we start to get a little bit more of a chance that we see a 5 handle in the lower end of Fed funds. So 38.8 and 9%. So we have 40% chance that we'll see a 5 handle on federal funds, even though Powell is telling us we're going to have it. And not only are we going to have it, we're going to have it for a long period of time. Like, what do you think about that?
Yeah, I think that's just a kind of a narrative that they're going to press the handle until they see inflation going back to 2%. I think that's target first is kind of oblivious in my view. Target back to 2% in the deglobalized outsourced manufacturing. I mean, that's kind of an idea which I cannot reckon with.
The genie is out of the bottle.
Yeah, the genie is out of the bottle.
And I mean, you're not putting it back in.
We're never going to go back.
No.
I
agree with you.
So.
I agree with you.
Yeah, so that's the first thing. The second thing, CPI has been moving lower from 9.1 to 7.1 consistently in the last year. So what does he want? I mean, 2-year is trading currently where the Fed funds are. So what he's going to do? He's going to be above that for like 2% for, I mean, does he really think that he's going for 2%? Nah, I don't think that's a real story. I think he makes one more hike. And especially if the CPI goes down next week, I think he's going to pause.
Yeah.
In March.
Yeah.
That's my take.
Yeah, I agree with you. And I see we have a Benzinga guy here in one of our channels. Is that Mitch?
Whoa.
Money Mitch, what's up? Do you want to come in and be a guest, Mitch? If you want to come in here, let me know. Send me a quick email. Todd at Trade Analysis. I'll bring you in as a guest, brother. Love to have you. I don't know if you can slum it in shows like ours, but love to have you, man. Okay, so just kind of resetting. The market has been incredibly sideways pretty much since the end of December, right? We've been in a range. We'll cover the indexes here. We'll show you where we are from Elliott Wave point of view. A lot of back and forth today. Alex sent out a video midday. You guys probably have seen it and watched it 3 or 4 times by now, right? And also given a thumbs up. Actually, no, that was on our email list. Never mind, that didn't go out to YouTube. But you know, before we show you longer term counts, the market, it's most important to realize that we have been sideways since December 14th, right? We've been very sideways until the end of the year. Here we are, first week, and it's kind of like summer vacation. Once you get August, it takes usually the first couple days of September for people to settle back in, kind of get their bearings straight, figure out what the plan is for the year. So I think you're right, Alex. We don't really have a lot of movement to figure out which way is up at this point. The main thing that we're seeing is that there continues to be more relative strength in the S&P because there's going to be more value-oriented stocks than there are in the NASDAQ. The NASDAQ has retraced more of the October to December move up than the S&P has, right? So I'll show you, Alex did this earlier. If you're on our email list, you would have already gotten this email. But the fact, or the big debate is, what is the move from October 12th up to this double top in December? I had it as wave 5 ending here, and we need to have a 3-wave move back down. Alex encouraged me to go to an A, B, C, which would be expanded flatted. Now, I'll show you the details of that. But the S&P has pulled back into what we're calling the should-hold zone and the must-hold zone. Should-hold zone consists of the 50% and 61% retracement of that October to December move. The 786 is what we call the must-hold zone. Anything that doesn't hold the 786 retracement, in our experience, don't expect a double bottom to hold. You're often going down to the 1272 extension, which would be a new low, okay? So S&P's retraced 3780, 3712, which is 50 to 61, where the NASDAQ, because value continues to be stronger than growth, NASDAQ has pulled all the way down through the should hold into the must hold. And what's funny is the NASDAQ, ever since December 21st, has been just hanging around. The kid's got alligator blood. That's a terrible John Malkovich impersonation, Alex, from a show called Rounders. You ever watch that movie?
No.
Oh, so good. Matt Damon, John Malkovich. He's a professional.
Oh, I did.
Poker
Yeah, I did with the cookies when he's eating
Yeah.
the Oreo cookies when he plays. Like listening what they're telling. It's a great movie and it's a great role. I mean, this guy is like
hanging around. Yeah.
Amazing.
It's great for trading too. It's really good for trading.
Yeah.
Just how to, either go for the throat and and try to go for the big win and roll up, go to Vegas, or John Turturro, I think that's his name. He's like, screw you, man. I don't go for the big hit. I trade, or I play money. I trade or play poker to feed my family. And there's a lot of good back and forths with similarities with trading and poker. Anyways. Sorry for that aside, but the NASDAQ's just been hanging around here, waiting to find some kind of direction off of this 786. Now, there's a ton of debate, in the LIQUIDITY community about diagonals. And, oh man, I don't even want to get into this, but R.N. Elliott, Ralph Nelson Elliott, left us with 5-wave diagonals back in the 1920s, 30s, and 40s. Hamilton Bolton, Charles Collins, Robert Ray, who did kind of observe some of the Elliott wave work, handed that off to A.J. Frost and Bob Prechter, who then put more rules on the diagonal, and the Elliott wave community is left fighting with each other based on what the specifics of a leading diagonal are. So whatever, that's a long conversation that we can have later. But is it 5 waves up, and we just did A, B to a new high, C wave down into 786. Now it's possible, but the issue is there's nothing that looks impulsive off of these lows yet. And you need a good 5-wave move up off the lows to start to suggest that the low may be in. And a 5-wave move looks just something like that. Just a nice little 5-wave move. And there's nothing there that looks like it. So today's session, is kind of concerning as we head into next week's data. I thought we had a breakout yesterday on the opening day of the year. We had a big gap up, and then they closed the gap hard, slammed us right back into the range, and that's where we are today. So, where are we? It's incredibly challenging to figure out where we are. We are facing the fact that we do have a 5-wave move off of the highs here from mid-December, right? And after every 5-wave move, you need to have at least a 3-wave correction. That 3-wave correction, could turn into something more, as I'm showing based on this bullish interpretation. Okay, so that was the intraday chart. This is the daily chart. This is saying that we have a wave too low, and we're in fact going to move higher now that we do have clarity on where the Fed is. We are heading into earnings in 2 weeks. Okay, so we need to square up with this 5-wave move. This bigger interpretation says we rally. The other possibility says that we still have a 5-wave move off of that December 11th high, but this is going to be a corrective affair, and we do have another decline to go down around 10,000 in the NDX, 3,200 in the S&P, and that is going to be, again, this is another movie reference for you, Rodney Dangerfield's correction, which is the triple Lindy, which is the dive he did in the movie Back to School, WXYXZ. And what I like about this, and I want to get your input here, Alex, is more so on the S&P for this bearish interpretation, the triple Lindy correction, the WXYXZ. If you look at the heart of this thing, let me get my drawing pen. I kind of like the expanding nature of the motive waves, and I'm getting a lot more Elliott-esque than I want to, but here's what I'm talking about with this. So in the correction, in the triple correction, you have correction 1 with an X wave connector, Elliott wave correction 2 with an Elliott wave correction, Elliott wave correction 3. So it's W X connector, Y X connector, and then another ABC and for the third correction. What's happening here is the depth and the duration of each one of these motive waves, because motive is pushing this correction. The trend of this correction is down, so any wave that pushes it is going to be a motive wave. So the depth and duration of the first motive wave was this. The depth and duration of this next motive wave was longer, and it took, in terms of price, and it took longer in terms of time. And then the same thing's happening in this next one. The depth of this guy, if we are getting down 3,200, is deeper and longer. So it kind of has this expanding quality to it, which, combined with the lack of any real motive impulsive move up off the lows, as I just mentioned, is starting to get me to think that we might be heading lower. We have long positions on. I'm long in the wealth management, but we do have hedges on. And we have had QQQ hedges on with clients. We've been rolling those put spreads down. I'm happy to show you that trade if you like. So I'm not, the idea that we might be heading lower, that idea is not lost on me. And I do also could see, let me delete my drawings here. This is the little QQQ hedge that I have going here right now. We have 13 Jans, 277.5 put, 255 put spread. And I started out as a 270. I rolled it down to 260, went down to 255, 9 days to go. So, this just some of the hedges that we have on, not outright short, because I still am holding out hope. Alex, what say you, sir?
Yeah, it looks like a growing kind of a nice pizza when you look at the expansion. More you cook it, kind of more it expands. Yeah.
Oh, okay.
Yeah,
all right. I see what you're saying.
Yeah.
Okay. All
Yeah,
right.
yeah.
It's like the crust is rising.
Yeah. So, yeah, that's the fear of the Fed of overcooking it, so that's the main, so they are afraid, so they pull a plug on rates too early. So I would say our house wave count on a cycle degree, it's obviously still bullish. I mean, that's a statement we need to kind of underline. So we don't think this is the end of the world. We don't see yet the conditions that this is creating, especially on many sectors analysis that we did, that the world is turning into some 10-year bear market period. So this is just a kind of adjustments of our overall bullish wave count, where the things are going to continue on the upside, where the rates on the macro degree will pause for some time or even go lower. Yeah, I hear you. I'm definitely still as I look the cryptos, and sometimes the cryptos has been a leading indicator as it behaves like a high beta Nasdaq play. We have, I think, more downside on a Bitcoin, which might kind of agrees with your fears. So yeah, so I'm still looking to a bit move lower, and I'm very well aware that this might happen. So we are not out of the woods. It's very difficult to take a firm side, to take a firm trade at this point. So I think we are still on a shaky ground until we see some of the decision points. But man, this looks like a. I mean, I hoped for a more rallies. Looks like a correction, we have to admit, at least for now, this couple of days. So yeah, kind of puts us in a end of March, and yeah, most likely. I mean, it definitely shouts increased probability we're gonna. I will not make my statement firm. I mean, as an analytician, you need to go back and forth kind of, but I think probability maybe weights a bit more looking these correlating markets, that we might have a little bit more downside.
Yeah, I think so. I think it's a possibility. I'll tell you what, I just sent you a message on Slack. Hop into Zoom so I can share your screen. And then,
Yeah, sure.
you know, speaking of macro, and I think, you know, where the longer term rates are going is interesting. So here's 10-year yields, and you know, we made this sort of observation this morning with the members that if you throw the S&P over it, instrument overlay, I'll just throw the S&P futures, you can see that there's a pretty good inverse relationship between stocks and yields. And it really was born in pretty much when 22 came around, right about here. Okay, so in 22 we had, you know, pretty much stocks in green and the 10-year yield moving up together. And then what happened was, you know, I'm looking at a little bit of divergence here. What happened was the stock market peaked out as soon as the new year came around and yields started to go on a tear. And from an intermarket point of view, you know, there's a pretty good divergence here as yields did not make a new low as stocks were making a new high, right? So that was the first kind of sign there. As the stock market was at new highs into the end of 21, yields based on this, you know, based on that correlation should be down here, right? So then we started to go into an inverse relationship as 10-year yield went up to 4.4, the S&P started to push lower here. And you know, if we then get into shorter term, okay, you can see that we clearly have an inverse relationship here. So go ahead.
No, I'm just looking what you're saying. I just remembering this period, I was also reluctant to see a secular change in inflation. So I think this correlation will be more and more as the market got aware that that yields are going to go higher. You know, like as you can see on your chart, you can notice that they were going hand in hand up to 1.5% until market realized on the end, oh my God, included me too. I was thinking we have a little bit more lower to go. But when market finally sees the idea inflation is here to stay, at least for some time, and then the stock starts to plunge. So I think it's a viable relation. I mean, you're explaining, and I think it's going to stay like that.
Yeah, I mean, and those correlations come and go. You know, they come and go. Right now, you have stocks and bonds trading together, and if you look at the longest degree of trend, the long bond does have overall positive correlation with the stock market because rates have been falling since pretty much I've been out of diapers. So, you know, stocks and bonds
that long.
Well, 79. I think it started in 81. Actually, the birth of the bull market in 82.
Yeah, 80. 80,
81, 82 is when it started.
Yeah.
So maybe I was out of diapers.
Oh, my Lord.
You're not that much older than me, Alex.
No, I was actually. You're in diapers. I was getting a lollipop, or how you call it.
Yeah, that's fine. Yeah. So you know, and just to think back, like, okay, so I wanted to bring out that correlation with the end of the direct relationship, sort of, because stocks made a new high, but then all of a sudden yields started to push higher as stocks sold off. And then if you look at, you know, the relationship, how far, ever since we went up to 4.35 in the 10-year, you know, we came up to a 50, 618 retracement, and I do have a little wave count that I can share with you guys. You know, I'm not, you know, pounding the table on this interpretation. Let me get the S&P out of the way. But you could make the case that we have 5 down here in the 10-year, ABC up, went through the 50% retracement, fell short of the 61% retracement of 3.93. And as the yields have gone up, the stock market has gone down as you would expect. But if you were paying attention on my opening chart, okay, before I flip over, you know, how much has the S&P retraced here as the bond market, as the yields have backed up? You know, we're at 3.38, went up to 3.9, 61% retracement of the October to December move. How much did the S&P retrace? But opposite. And that's what I opened up in the beginning. And if you're paying attention, like, good on you, man. We did a 50% retracement of the October to December move up. We went down to the 50% retracement. So right now you have a case of the stock market is actually acting stronger than yields are in the case of the S&P. Now, granted, the NASDAQ is weaker because we went down to the 786 retracement of the October to December move. And obviously we know we're still very much in a value-driven market. You know, we have transports, industrials, and healthcare materials all acting very well in here, and staples. Energy's starting to rotate out, and I'd like to talk about that one a little bit. But value trade continues to be on. So can we have a sustainable rally with value being on the forefront? And that NASDAQ, as I opened at the beginning, just hanging above that must-hold zone of the 786 retracement. I'm starting to think that maybe the answer is no. However, if we can break on the 10-year below 3.63 heading into next week's CPI, and we do have non-farm payroll Friday, so we'll see if that does anything. But if the 10-year yield can break below 3.63, bonds get bid at the long end. Does the stock market take that as a risk on? And is that a good thing? Because, you know, that would start to suggest that long-ended inflation, 5-10-year inflation expectations are anchored. I don't take that as a growth fear that they're buying long-term bonds if longer-term rates are falling. I actually think the stock market would take that as a good thing. But if I'm wrong, if we do break through 363, and we start to head back to 3.3, 3.1, maybe back to 3, how does the stock market react? I think that's going to be very telling. And then, Alex, I'll flip it over to you. You sharing your screen on Zoom?
Yeah, I can share it now. Let me just.
And then I was going to flip the dollar to you, and you know I haven't actually looked at the dollar. I was going to have you do an update there.
Yeah.
Tell me when you're ready to go. dollar, and I'll wait for your zoom to pop up.
Sure.
Dollar just continues to be such a feeble bounce. And I still think we're probably in this sort of sideways wave 4 in the dollar. There's a whole zone craziness of fib support down here that we have been holding, but the dollar can't get a bid. And that means, again, if this is wave 4 in the dollar's going to sell off. That's a good thing because the strong dollar has been hurting the stock market. But the dollar can't get off the mat now. So that would tell me if yields are going to drop, the dollar drops, that's got to be a good thing. So if long dated bonds do get a bid, I would say that is a good thing. And the reason for that, let me just throw a chart at you here. Let me go into Y charts here. I think because we're not trading based on inflation expectations anymore, I think long-term inflation break even. So let me do this. I didn't plan on bringing this up, but let's go 5-year tips break even. So 5 years at 2.55% in terms of the 5-year inflation expectations. The 10-year, I think, is lower. 10-year tips break even is at 2.26. So, I understand if yields want to go lower, that's going to further invert the yield curve. But, is that what the Fed wants? I guess. I mean, we need short-term rates to go up and try to squash inflation. But if we think inflation is going to be transitory and the Fed will eventually catch down once that data starts to filter through to CPI and PCE reports, the Fed will normalize, but those longer-term rates will stabilize, and the curve will start to flatten a little bit. So, again, I don't take it with long-term inflation expectations 2.25 and 2.5, 5 and 10 years out, and your 10-year yields at still at 3.7 and 3.8 in the 30-year, 3.87 on the 5-year. I have to think that long-term expectations coming down is a good thing for equities. So if you see those 5+ year maturity bonds go up, I have to think that's a good thing for the market. All right, Alex, I'm going to send it to you. You are up. Go ahead.
Yeah, sure. I mean, I see down in comments about gold. I mean, we have been looking at chart back and forth for the last year on gold, looking for that wave 4 lows at 155, 160, 100. So the main themes, as you said, it's 5-wave move down in dollar. Obviously, dollar is a mix of a thing. It's not just, you always have a couple of things, a global liquidity, because it's still a reserve currency and it's not going anywhere. And these stories like dollar is going away, blah, blah, blah. I mean,
I'm so tired of hearing that, Alex.
Yeah, even that, even in the history, the transitory, even if you have a global power change, which is kind of a nonsensical currently, that process can last 30, 40 years. I mean, so I'm telling you this because obviously we are seeing a small cycle dollar top, 5-wave move from 2008 crisis. So a sharp move on the downside. As you know, this story is the same as the dollar is also connected with the emerging markets. 70% of loans in the offshore dollar markets are denominated in dollars. So as the dollar go weaker, these economies do better. So they generally lift also a little bit more of a stock markets there, which kind of affects everything else to a certain degree. So I think dollar lower is definitely good from this point. But as you said, we're going to correct on the upside very soon. I'm talking short term. So this correction, I mean, man, this dollar is usually nasty. It doesn't correct like on a previous wave 4. it kind of tends to test 0.786 every time it corrects. It's incredible. This kind of fits in a picture. If we look at it through the dollar lens, we go a little bit higher in stocks, then we go down for this move, and then when dollar actually tops here in this ABC and starts moving lower, we have 2 or 3 years of a new dollar downtrend, and then also the risk assets on, just from the perspective of dollar. I'm not talking rates and other stuff, but also interest rate differential is one of the things which is moving currency markets, and this is clearly visible.
That's the core mover of FX markets.
It's the core, yeah. But after a pullback, it's clearly that either other banks we're going to catch up with Fed, or we're going to see rates move a bit lower. So I'm on that train with you. I think dollar it's going to go lower in the next 2 years after this, 3 years after this corrective pullback, and we see that on many other markets. So let's look at this gold chart, which this our viewer was mentioning. So
Alex,
yeah,
if we don't rally in gold from above 2,000 with everything that's happened, can we agree to never talk about gold again?
Yeah, I agree. Yeah, I agree. Yeah,
I'm so.
Yeah, but it's
go
a
ahead.
funny
Sorry,
story.
I'm sorry to interrupt. I'm sorry to interrupt.
Yeah, I agree. I agree with you completely. Remember the old times? If we had a global event like a major, one of the major forces goes into war in the middle of Europe. I mean, in back in the days, gold will go.
It was
like,
gold and
I don't
Swiss
know,
francs. Gold and Swiss franc would rally.
Yeah,
exactly.
and to a certain degree, Japanese yen.
Yeah.
So I mean, we will be at 3K on gold. So what it did, it just plucked 100 to 150 bucks on the upside and then moved lower. I mean, amazing. Yeah, but I just look at it as your Elliotian, okay? For respect of this stream, just remind the narrative around it. Yeah, 1, 2, up in 3, 4, and 5. So relatively simple Elliott wave count. So from the daily wave counts, I think we are going higher, and it kind of corresponds chart in the dollar index. So 1 down in 2, in 3 waves, and then we continue higher. So I see that on many other currencies, which also supports narrative over lower dollar in 2023, 2024. So from the currency perspective, dollar tends to be weaker after, let's say, May, June next year, following 2023-24, because we have almost 5 waves up in a pound, in euro dollar, in Aussie dollar, which is, as you know, a good proxy for risk-on assets, and it's I think correlates with all of what we are saying here. So
yeah.
I do see the same thing. So the main theme, main subject for the opener, it's, yeah, guys, this is a correction. It's not the end of the world. We are seeing maybe a little bit more downside, but on the several sectors, several macro themes, even in cryptos, we are seeing things going on the upside. So this is kind of a main message, which I think we are trying to transmit.
And I don't want to get too much. I mean, this is all good, but let me throw this one in front of you. Back to crude oil. Okay, can you see my screen? All right.
Yeah.
So white is the 10-year yield, and green is crude oil.
Yeah.
So that's a pretty big macro divergence that needs addressing. Either crude is much too low.
Yeah.
Or yields are much too high.
That's a kind of a tricky call. I agree with you, because obviously price of energy affects, of course, inflationary narrative everywhere. It goes into everything. We move. Still, we are not in the a new age out of the fossil fuel era.
Fuels, yep.
Yeah. So I think. I mean, we came too much geopolitical on oil in that respect. I think 2022 divergence started almost after the war broke out. So I don't know. I agree with you. Maybe rates are too higher. The correlation is obvious, but I think it goes much beyond the usual account. This doesn't function now on a usual manner. You know.
Right, right.
Oil
I mean,
market is yeah. I don't know.
hey,
Oil markets are so tricky now with all of this what's going on. So I will yeah. It functions pretty nicely. Yeah.
yeah. I
I see
mean,
what is your point. Yeah.
yeah, no, and it matters as I want to roll into the next topic, which is talking about XLE and energy, because I continue to be overweight energy. I've been overweight energy since I launched the wealth management business, and I'm looking for all these macro signs, including the technical signals, which I'll show you here, that we might want to be easing up on that. And just looking at that 10-year crude oil, I should be doing a spread between the two, but it looks to be that Jan of 2016 was a pretty big spread, as was January of 2019. Looks to be a pretty big spread. And here we are in January of 2023. Looks to be a pretty big spread. So what was that year? That was 16 to, so that's 3 years. So it's 3, and then 4 years. Okay.
Yeah, I don't know if the oil price after a consolidation will go up because we will use too much of electric or other vehicles so that it's going to become scarce, or the geopolitics is going to play out and it's going to become a lot more expensive. So
Yeah.
I don't think that oil is done. At least
Yeah,
this
I mean,
is,
we have
I mean,
Terry. We were talking to Terry earlier. Terry couldn't be here. He had an appointment. Oh, and by the way, sorry, I'm jumping all around. Sorry for the late. I should have did this in the beginning. Sorry for the late video. I had CNBC this morning. I was on Tech Check with John Fort, which is fun. We were talking about Microsoft. I was talking about Meta. We were talking about, I was going to go on for Amazon, and we can talk about some of those names. I do want to show you an Amazon chart. So that's why this is late. I had to push everything back today because of CNBC. But this is the sector rotation that we like to follow, relative rotation. And anything that's rotating down and to the left is rotating out of favor relative to the benchmark, which is the S&P. And this is the orbit that Energy XLE has been on. So we started to fade here in actually just October, November. But since then, you can see XLE is dropping, and we've gone from the leading into the weakening quadrant. And some of the names that have been rotating in are real estate, utilities, materials, industrials, staples. That's all the value trade, right?
yeah, all the value, yeah.
All the value. XLY, consumer discretionary, is out. It's getting crushed. A lot of it is, Amazon and Tesla. XLK is trying to make the move back north, but it's just starting to sell off.
Yeah.
Apple really needs to find some support. I'll show you support 126, 123 in Apple. Semis are acting well, but then all of a sudden, which is weird, this market, all of a sudden we're getting XLC communications starting to make a go. So we had some kind of lower market cap, medium market cap communication companies up like 20% yesterday. Some of them are Chinese names. We're starting to see a little bit of support in some of the larger XLC names. We've got Meta coming back. You have Netflix showing a little bit of support. So, even Google's hanging in there okay. But, we're starting to see a little bit of move there. But the value trade just continues to be the big one, right? The value continues to be the big one. And, where does that play with energy selling off? And, Alex, do you have the XLE wave count handy? Or do you want me to bring it up?
No, it's okay. Let me just find it. So we are looking for XLE.
Yep.
Yeah, it's here.
Okay, so go like daily, longer term. Just show that triangle that we're starting to move into.
Just a second.
There you go.
Yeah.
So you look at longer term. Why don't you just take us through this here? What are you seeing on XLE Energy ETF?
Sure. I mean, this is a relatively simple consolidation. So people also does not reckon that in Elliott wave world, triangles are something which is rare. And when you see this consolidation, which actually means it's just a kind of a pairing up because we need to see the two larger corrections, wave count on the XLE describes that just another pause, kind of a balance between the bulls and bears until we continue higher. So actually, we count this as a 1-2, so intermediary wave 3 can go to 105, 115, but we still think it's not a time we address any so it's not gonna go and kind of collapse. We just see a longer term consolidation before the condition appears. It continues higher. So 3 waves down in A, 3 waves up in B. B went a little bit more on the upside of this wave 3, which make this a contracting triangle, which means that the lines are going to contract. And these waves, which are going to be subsequent, it's going to be smaller and smaller. So we are down in a C wave, up in a D and E. So in a couple of months, this might play out, and then we might continue higher on this. So obviously, we still stay bullish with the intermediary pause on the XLE,
And then
which is basically sector rotation is suggesting.
exactly. So, we started to roll out here at the end of October. We're starting to roll over here in November. Was November the B wave high, Alex?
Let me look.
Yeah.
Yeah, November 10, exactly.
And then as soon as we drop down, so the high in the rotation was in November, and then we started to drop down in November. And then, as that orange A of green C, as we started to enter the territory of the prior correction, that was starting to confirm that this was not a new 5-wave move up in energy, and we needed to go sideways. And so, I basically am looking at lightening my energy positions, because if energy is rotating out and we're going to consolidate for a while, and of course, this means it's rotating out relative to the S&P. And the question on the table is, what's rotating in? Energy has already had its move. Are we going to continue to see financials are kind of rolling out? Industrials have been strong. Staples have been strong. Real estate's been strong. Utilities have been strong. Healthcare's starting to roll over.
Maybe communications. Yeah.
I don't know, man. I mean, I don't know how.
Yeah, I mean, this sector.
No, I mean,
this sector.
I don't know how communications could make a go while XLY and XLK, consumer discretionary technology, is right on the map.
Yeah.
I mean, but on the other side though, Alex, XLC's already made the move. We've got some relative strength in some large cap communications. Consumer discretionary is like down and out. It's gotten crushed, and it's starting to slow down, make a move. XLK is trying to go, but just got stuffed at the lagging, improving divide right here. I mean, just keep in mind, like you just said, before I dismiss it, what you're saying, there was a long time ago out on the monthly that XLE energy looked like this relative to, this was only in November 20, this is 2-3 years ago. I mean, you would have thought that we were going to EVs and fossil fuels would be outlawed forever. And then what happened? Wham! One of the best trades that's happened in years.
Exactly, yeah.
XLE was up 50% this year. Everything else was flat.
Yeah,
amazing.
Amazing.
You know what I mean? So what you're saying is a good thing. And, XLY on the monthly is nowhere near what energy was. But on the weekly, it's a little bit of a different story, as XLY has really gotten its clock clean here ever since the end of 22. And maybe we're rotating back, and, maybe the value trade is not here to stay. I want to go on a slightly different topic. Alex, is there anything you want to say? I just was going to transition to the growth value and where we are in terms of expectations for earnings for S&P and try to shed more light on this growth value debate. Is there anything else that you want to talk about here at all?
No, sure, go for it. I just see that communication was so beaten down. I mean, sector is down for years, you know, and there is a couple of big names there. Yeah, even if we continue, so it has been moving lower for next last year and a half. So yeah, I'm just going to continue to watch that. A couple of interesting ideas, but still there is a bigger wave count which shows we can continue lower. So yeah, go ahead. Let's see what's up front with earnings and the stuff ahead.
Yeah. No, I don't want to rule anything out, as the market is just so sideways and so confused.
Yeah.
I wanted to show, I had the chart ready. I wanted to show, where'd it go? S&P sectors. Where's my boy? I really like the pieces that Ed Yardeni sent out, and let me just get to this. I had it ready and I closed it. It's going to be here in 5 seconds. Really like Ed Yardeni's account, or his work. I subscribe. If you guys don't, I recommend it. It's very reasonable if you're looking for a good macro look. But this I thought was really good. The Bears' favorite chart, and this is something that I've looked at, many times in the past, which is just talking about the size of the Fed's balance sheet. And so balance sheet is on the left scale in blue, S&P's in red. And you can see that the two are clearly correlated as the Fed has bought more assets, injected more liquidity in the system, the S&P's gone big. And it's easy for everyone to say, well, okay, we're going into quantitative tightening now. Stock market has got to get crushed because the Fed balance sheet is all the way up here. And it's easy to say that the market should 2,000, 1,000 S&P, blah, blah, blah. He goes on, and this is free right on his website, which I think is really good. And, again, I've looked at the Fed balance sheet overlay, and I just haven't done forward PE on here, overlaid it, which is, I think, a nice visual. What this says is, okay, here's Fed's balance sheet in blue on left scale. We were up about 8.6 trillion. Yeah, now I think we're down to 7 point. I think we've rolled off 8.5 trillion. We're at 7 point something now. We've started roll off, and we're running off 95 billion per month. And the Fed's assets would drop 2.8 trillion from the high, 8.5 trillion May of 2022 to 5.7 trillion by the end of 2024. Okay. Well, what's happened to the forward multiple, to the expected earnings that the S&P 500 is going to make next year? Well, we're up around 230, 240 earnings per share. So, so what is it? $45, $50 a share per quarter for the S&P earnings. But based on the idea that rates are going up, the Fed is going to be tightening in terms of withdrawing liquidity from the system by letting the balance sheet roll off. Look where the forward valuation has gone. It was up around 23-ish, 24. Keep in mind the forward PE has already dropped from 21.5 on January 3rd of 22 to 16.7. So at the end of 21, beginning of 22, or 21 and a half. Obviously, we were higher than that, probably 22, 23. And now we're down to 16.7 forward earnings. So all that means is, okay, so if the S&P is at, 38.80, and we're going to make, call it 200, maybe $210 a share, maybe, that's 18 and a half times earnings. If it's going to go down to 200 or 190, it's going to change things. But what I really like about this is that forward valuation in terms of where the S&P is supposed to, the amount of money we're supposed to make is 15, 16 times forward earnings. You saw 15, 16 times forward earnings back here in 2014, 15, when the Fed balance sheet was $4 trillion, half of what it is now. So you could clearly say the stock market is discounted in the reduction in the Fed balance sheet. I mean, and as he says up here, the current rate puts the Fed balance sheet at the end of 2024, not next year, but the year after, at $95 billion per month at a 5.7 trillion Fed balance sheet, which is up here. But yet you could go back and say we've seen 16 times forward earnings in the S&P with a Fed balance sheet of 4.5 trillion. So you could say that the market is actually undervalued here. We should be trading 17, 18, 19, 20 times earnings to have the equivalent of where the Fed balance sheet's going to be according to their schedule. So you can say the market actually is undervalued. And I thought that chart really, really pulled it together quite well.
Yeah.
And then go ahead if you want to say anything on that, Alex.
No, I mean, great presentation of difference and the forward lookings, how markets are actually looking forward 6 to 18 months in advance.
Yeah,
Yeah.
exactly. And then there was one more I wanted to show. I don't know if I'm going to be able to find a stock market briefing. I had it all set up and I closed it. Basically, I'm not going to be able to find it, but he was doing a great job of showing that the underperformance of growth to value on a year-over-year percent change basis has never been this bad until the low in 2001, right?
Yeah.
So value really started to move up as tech started to sell off. So everyone's counting out, including us, the growth trade for value. But based on what I said just here with where S&P is in terms of forward earnings, where Alex was saying with clarity on where the Fed is and in terms of inflation finally trickling through, I can't help but wonder if people are on the wrong side of the market and specifically too heavy on the value trade. I'm not trying to, I'm just talking to myself. I'm not even trying to really talk to you, the viewer. I have a rebalance coming up in my portfolio for the wealth management, and I'm overweight energy. I need to back that off. I have some good value exposure. I can't help but wonder some of these pockets that are coming up in consumer discretionary and communications we might need to be looking at longer term. And I talked about it today on CNBC with Meta. Meta is one of them. You want to talk about fundamentals on Meta and where that is and how they're handling the cash on the balance sheet and the valuation of that company, and the fact that advertising is coming back to social media and it's not fleeing to Pinterest and Snapchat. TikTok is now the focus, and I can't help but wonder if Meta is somewhere we want to be longer term as well. So, all right, sorry for that ramble. Alex, do you want to roll into some crypto? You ready for that?
Yeah.
Okay.
Let's look what's going on with the Bitcoin and Ether. Let me just give me a second. So do I still have a screen so I can put it out there, or?
You are up.
Yeah. So I'm observing this with our members. So this is a kind of a longer term wave count, and I will really like to pick your brain on this. So didn't have a time to chat with you on this one. So when you observe this kind of a construct, when you have you remember all of these phases, we were pretty much on all of these phases on the Bitcoin. The question is time relation between the wave 2 and wave 4.
Yeah.
So do we consider this from the Elliott wave perspective? The wave 2 was also relatively, it was a COVID low, and then we have a balance sheet expansion, and then we go up. So we are very close around end of January to 618, which I think we mentioned. We look this as a last resort ratio to even consider this to be a fourth wave. Would you reckon with that, or?
Well, how long was wave 2? So it's summer of 19 to what, spring of 20?
Yeah, I will tell you. So it started at
June of 19.
June. Yeah.
Yeah.
2019, and it's finished
So, okay, so it was,
in March
so,
2020.
so it's 21 months, okay?
Yeah,
And then, yeah. And just do, I
we
mean, a
have this.
4v2. So, I mean, you're looking at it right there. So we're at a 2.618 relationship. So
Yeah,
21 months times 2.618. It's pretty large, right?
yeah, yeah. It is pretty large. So
It,
this is something which I have a concern. But overall, even if this is just a five-wave move, wave count invalidation is very close. Although on Ether we are not near wave count invalidation, which is an interesting. I'm going to show you the chart. This is just not about crypto. It's also an Elliott wave talk. So as you can see, wave count invalidation 13,800 and something. So it differs from the data provider. So even if this is just the beginning of a new cycle down in a five waves down in A, up in B, down in C, we're gonna have a like 100% move on the upside in the correction. Okay.
is there any way, Alex, you could take orange circle B from July 21 low and make that 5?
Yeah, there is. I mean, I'm
I mean,
gonna
that
show you
solves a
smaller
lot.
time
That
frame.
solves a lot of problems, you know?
Yeah, I know. Yeah, so you see,
You're
I
like,
already
yep.
have that.
Hey, man, don't ask the question if you don't want the answer.
Yeah, so it's already there. I mean, you know, I covered that all. So in that respect, you can count five waves up here. This has a flat in a wave 4 and a wave 5,
Yep.
but
Yep.
127 here is also predominant, and on a bigger cycle, there is not much of a relation between this wave 5. But since crypto is a new and it's a thin market, let's say this is just a five-wave move. So anyhow, we're gonna have a B wave up very soon. Okay.
Yeah.
So this
Yeah.
kind of
In
agrees
either
with
wave count.
yeah,
In either wave
in
count.
either way, in
Right.
either way.
And this
okay?
this one would allow and probably bring on a break of that 13,097 because you know the Elliott wave community,
Exactly.
which is heavily Elliott wave oriented. They're going to try to break through it, and then that's the explanation for it.
Exactly, exactly. So anyhow, this kind of goes with the Nasdaq a touch lower because 13,000, 14,000 will be the lows because of the specifics of this ending diagonal relation between the waves. And if we go 5 versus 3, which means that the fifth wave, third wave cannot be larger, fifth wave cannot be larger than a third wave, it comes around 13,255.
Oh, there you go. So then you get that little wave count break.
Yeah. So
Yeah.
basically, we know the region. This is obviously an ending diagonal because all of these subdivisions you can count in a 3 waves. So this kind of corresponds, I will not say unfortunately, but kind of leans on our bearish outlook currently. If we can say this correlation is functional, which it is. Yeah.
Well,
So Ether, yeah.
yeah,
So,
no, go ahead. I want to
let me
see either.
just-
Go ahead. Go ahead.
I just wanted to show you today, you asked me about the Ether Bitcoin,
Yep.
and this still portrays a bullish development. We flagged to our members actually these lows here. It was far back in 2021 in March. So this was a leading diagonal in one down into a little bit whipsaw here in a wave 3, 4, and now I think we are doing a wave 5. Obviously from this wave 4 lows without the wave count invalidation, we have a straight 5 waves up, and this is just the A, triangle B down in C. So I think from 0.06, Ether in the next cycle, either being a new highs or just an ABC, will outperform Bitcoin towards this
And
0.14.
just to slow down for viewers, make sure you
Yeah.
realize we're looking at Ethereum into Bitcoin. You're eliminating the US
Yeah.
dollar here. You're looking at Ethereum relative to Bitcoin. And that's a key
Yeah,
distinction.
this is Ethereum Bitcoin chart here. So let's look Ether. You always ask me about Ether.
Yep.
So from several standpoints, technically, Ether kind of shows a relative strength, which is seen on this cross, we are trading just marginally below 200 moving average. And I don't know, man, on Ether, this wave 4 doesn't look so funky.
No, it sure doesn't. I agree with you. It really doesn't
Yeah,
look
so
bad.
what if we kind of, I don't know by which we do 5 waves up in Ether and we just do 3-wave pullback on Bitcoin? So that's also, I don't know, maybe it's not possible in a percent change. I have to calculate these waves
Yeah,
on
you're
Ethereum,
1,397. I mean, that'd be a huge move. I mean, that's
Yeah,
1,300 to 8,300. So, whatever,
yeah. But
300% or
anyhow,
whatever.
I think that here I have two scenarios: either kind of a double bottom in wave 4, or a complete wave 5 here, and we have 5 waves down in A, up in B, like in Bitcoin. So I think cryptos from February, March goes up, and this fits in our overall story that risk assets goes on the upside for March.
And that's what, and it matters what, everything matters what you say, Alex, and that wasn't even good English. Everything you say matters. And it really matters for you stock traders as well, as Alex mentioned, and I'm just showing Alex Bitcoin NASDAQ overlay. It's still alive and well. So this is Bitcoin futures over NASDAQ. You know, and
Oh
it
my
goes,
Lord! Yeah.
it goes, you know, it goes back to the growth value trade. You know, if it matters what Bitcoin wave count is, where technical support resides in Bitcoin and Ethereum, because there is still very much a correlation between tech stocks and crypto. And are we seeing too much of a sway in terms of the value trade? And if by chance crypto holds up, you know, all right, well, you know, that's something that we need to really take notice of, because I would say that Bitcoin is actually held in better than the NASDAQ here on this weekly chart.
Yeah, in the last
And-
couple of weeks, yeah.
Yeah. I mean, look at that. Okay.
Yeah, amazing. Yeah, I think SMH is even more, kind of more precisely correlated.
Yep.
If you can overlay the SMH, I think it's going even better.
So these are the semi holders. So let me get NASDAQ out of the way. Actually, NASDAQ's a little better than, looks like semis are a little spicier than crypto.
Yeah, I kind of have a bigger moves.
Yeah.
Yeah.
right,
Nasdaq is more
let's-
smooth. Yeah.
That's good work. Let me just throw a couple charts at you, and we're going to wrap this up. Just talking about some of those values, or some of those tech stocks. Apple has been obviously in play a lot. China lockdown coming off. You know, now we have warnings of slowdown in demand, as well as input parts in China for iPhones hurting Apple. However, you know, where are we in Apple? This is what we're looking at here. This is not a 5-wave move down. And if you think, you know, that just stepping back, long-term, split-adjusted, logarithmic chart of Apple, like if you can tell me that that's the top in Apple, you're a better man or woman than I. Let me tell you for sure. I don't see it. But so if we get down to smaller time frame, you know, this is the monthly. Here's a 1 week. You know, there's not much that says 5 waves down, and 5 waves down is how tops are made. 3-wave corrective affairs down, that's how uptrends remain. So here's the weekly. We have some pretty good confluence of fib support here between 126 and 123 in Apple. And if we don't hold, we have another little pair at 18 to 120. So this is going to be a key zone we're watching here in Apple. Amazon, let's flip over to consumer discretionary. Focus there in Amazon, again, not a 5-wave affair on the way down. Choppy, sloppy, ABCX, ABC, ABCX, ABC. Looking for support slightly lower. We have a channel support longer term in Amazon down into 80 to 75. Sorry, losing my voice here today. All we've done today, Alex, is talk. This is our talking day.
Yeah.
pulling back in wave 4, squares up against wave 2 from 2008. So, does support exist here at 80? Or do we need to get on down to 63? But either way, we see it as a WXY of 4. Amazon's financials are starting to get back in order. AWS Web Services are solid. They're starting to kind of address their margin issues that have put Amazon and the consumer discretionary sector, as I showed you over here in RRG, under so much pressure. Tesla and Tesla and Amazon with the consumer discretionary. If you look at a non-cap weighted, equal weighted consumer discretionary ETF, it's a much different story. It tells you a much different story about the state of the consumer in this inflationary environment. So, Alex, is there anything else? Any closing thoughts, man? I think we got to put a wrap on that one.
Yeah, man, just amazed to dive into this intricacies of the different sectors and kind of a new research outlook to look for our members, a new stocks to actually portray our overall 3 components that we are cooking for the new trade. So it's kind of interesting how it overlays. So I'm still very amazed of going through sectors and find these correlations, because everything that is embedded on these technicals and everything. So amazing how these things works, like a relative rotation, or like it's like a small cubic, cube which you turn back and forth, try to figure out.
Oh, Rubik's cube.
Yeah. Try to find stocks which it's gonna portray the next market macro and indices moves. Interesting stuff. Yeah.
It's really awesome. Badur, I put Microsoft up there for you. Microsoft, I talked about Microsoft on air today, showing a lot of relative strength to XLK and QQQ. They got downgraded. Reasons for, I think difficult cloud service implementation next year. Slowdown in cloud is what some analysts are looking for, but Microsoft's showing some pretty good relative strength. And then, Alex, to your point, I laugh when people say, "Oh, do you use technicals or do you use fundamentals?" It's like, no, man, that's a dumb question. That's stupid. It's you need to look at relationships and capital flows that are driving the markets. You need to look at traders, investors, collective market participants, anticipation and reaction to data points that are in front of you. Data points could be the 200-day moving average, inflation expectations, where rates are, where the yield curve is, whether inverted or normally shaped. Look at sentiment. Look at any data point. It's the market's anticipation, reaction to when they get the data, and the follow through that is trading. So it's not like, I only use technicals or I only use fundamentals. It all plays together. Sector rotation is driven by where we are in the business cycle, which can help be identified by the macro flow. Sometimes FX is dead, and that's why you and I left FX, because it sucked for a long time. And now, after when we went to zero interest rate policy, but now it's back in a big way. FX is driving the flow. Commodities are now part of the flow. Fixed income is part of the flow. And you need to watch how that macro rotation impacts the stock market, because if you're trying to invest in the stock market, you don't know what the frick is going on sector rotation, on the macro flow, you're in trouble, dude. You really are. You need to understand what impact these moves in interest rates are that are being impacted as a result of inflationary move up. Look at the chart. We just have 40-year break higher in CPI. You're charting the data and people's reaction to the data. You can chart fundamental data. You can chart the last traded price on a chart. You gotta use it all. It's not like technicals or fundamentals. It all plays together to be a good trader, investor, and an analyst. Rant over, Alex. I think my voice is gonna go.
Yeah, man, we deserve a good stiff drink.
I think it's gonna be a beer night. Yeah.
Yeah,
All right.
beer night. Yeah.
Put a thumbs up, please, if you think Alex should have. What are you drinking? What are you drinking in Serbia, bud?
Oh, we have a domestic thing which is called rakia. I think you tried it when you were
I
here.
had it. Oh yeah, I had it.
That's something which is very unpleasant at the first. It's kind of burning your stomach, but it's kind of 60-70% alcohol. We also we also
That's
beer
120
drinkers.
proof. Whoa.
Yeah, we also like wine, but I'm mostly a beer guy, and I like cognac sometimes
Nice.
for a treat, you know.
Nice.
But mostly I drink beer here. When I drink beer.
Got it.
Sometimes tequila, you know, as well.
Good man.
When a slime day comes, yeah. I have a one day. You know, I have a one day in a year. I call it the slam day.
What's a slam?
It's when I go. Slam day. It's I go out at 8 o'clock and then I eat kind of a. We call it in Serbia. We put a good. We gotta put good surface above. We prepare the stomach, and then I slime myself until 8 in the morning. So.
Wait.
So it's amazing.
Wait, hold on.
Yeah.
You go out at 8 p.m. or a.m.?
No, I go out 8 p.m. and I come
And you
back
go to
home
8.
if I can 8 a.m. Yeah, that's one day in a year. It's called the slam day.
Oh my goodness.
I don't know. It's like this movie. These three guys when they go on a
Hangover,
how do you
yeah.
call it? I mean,
Hangover.
I don't know. I don't know where I'm going to finish. So you might put some tag on me, man, if I become too valuable.
Oh, you already are.
Just
You
to
know what?
locate
Well,
me.
I'll get you an Apple AirTag, and I'll have it put right in your pants where you don't know where it is, so we can track you on the globe.
Yeah, slam day usually comes around, let's say June, July, so still time.
Okay, kind of kick off the summer.
Yeah.
You're a wild man. Had a lot.
It's just one day. Just one day. Usually
And
I don't drink. Yeah.
And then it
just
takes a month to recover from that.
I'm still young, man. Tomorrow I'm fit, good as new, like tomato juice. And you know, my kid, he saw me one day after a slam day. He said, "I'm never gonna do this to myself in my life."
Yeah, perfect.
Yeah, sure. He was like pointing with me on a finger. He say, "I'm never gonna look like this in my life." So it was so funny, you know. Me coming into a home pretending to walk.
As Alex just
funny.
slams the desk and his camera moves, I think that's a sign that we're gonna wrap this one up. All right.
Yeah, sure, man.
So looks like I'm glad we have 6 more months until Slam Day. Slam that thumbs up button if you guys don't mind on the YouTube window.
Slam it.
Slam it. Let us know. Let YouTube know that Alex needs to stay home from Slam Day and figure out where this market's going. Just kidding. Alex, a lot of fun, man. Thanks for joining me.
Sure, man. No, always a pleasure.
All right. See you tomorrow. And